Welcome students, welcome to GK's education. All you know that partnership accounts is going on and we are doing the first part, admission of partner. Today we are going to do the very important part of admission of partnership. It is revaluation account. Very important part, and always in exams a question comes from this part. If this chapter is covered, so this part is very much important from examination point of view. So let us do it very clearly. At the time of admission of new partner, it has to be found out whether the assets of the firm are shown in the books at their current value. If the assets are overstated or understated, these are revalued. Means when the partner is admitted, we have to find out the actual value of assets if they are, or we have to find the current value. If the assets are overstated, means if they are shown at the more value as compared to the current value, then it has to be revalued. Or if they are shown at the less value as compared to the current value, even then they have to be revalued. Also, a reassessment of liabilities is also done so that these are brought in the books at their correct value. Means we have to recalculate the actual value, the current value of the liabilities also, so that in the books they are shown at the correct value. There also may be some unrecorded assets and liabilities of the firm. These also have to be brought into the books of the firm. So it may also happen that there are some unrecorded assets or unrecorded liabilities of the firm at the time of admission of partner. So all these have to be brought into the books. We have to take into consideration the point of goodwill also as per the condition given. So for all this purpose, a firm has to make revaluation account. So means for all these things stated above, for all the purposes, we have to make revaluation account. The gain or loss on the revaluation of each asset and liability is transferred to this account, and finally its balance is transferred to the capital account of old partners in old profit sharing ratio. This has to be kept in mind very clearly. The gain or loss on the revaluation of each asset or liability is recorded, is noted down, and is transferred to this account, and finally its balance is transferred to the capital accounts of old partners in the old profit sharing ratio. Now let us see what will be the entries. For increase in the value of asset, if the value of asset increases as a net effect. So asset on the debit side, asset is always our debit side, so definitely asset account will again be debited to revaluation account. And for the reduction in the value of asset, if the value of asset is reduced, in that case otherwise the asset is debit balance, so here asset will be credited with that amount of loss and revaluation account will be debited. So it is to be kept in mind. For appreciation in the amount of liability, liabilities are always on the credit side. So if appreciation mean increase in the liabilities, there it is a loss of a firm. So in that case, revaluation account, take it very simply. If liabilities increase, liability is always credit, so liability will be credited and revaluation account goes on debit, so it is a loss of the company as the liability or the payment side increases. So for the reduction in the amount of liability, now liabilities are always credit. Now if there is a reduction, that means liability will be debited, liability account debited to revaluation account. Very easy, and it will be a gain of company. For an unrecorded asset, if any asset is unrecorded, that case cash account debit to revaluation. For any unrecorded liability, asset means your cash will increase. So cash account debit to revaluation account. For any unrecorded liability, revaluation account debit to cash. For transfer of gain on the revaluation account, if there is transfer of gain, if there is a gain, in that case revaluation account debit to old partners capital account. For transfer of gain in their old profit sharing ratio. For the transfer of loss, old partners capital account debit to revaluation. Now all these are the basic entries. Let them understand with the help of the basic pro forma, that will make you much more clear everything. Now it is the basic pro forma of what we call a revaluation account. Here on the credit side, by asset, if there is a increase in the value of asset, if increase, then by it will be on the credit side, like asset balance will, as in the entry we have done, assets balance will increase, so definitely asset to revaluation in the revaluation account by asset. Opposite side, if there is a decrease in the amount of asset, then to asset, decrease in the amount of asset. Liabilities will go opposite. By liabilities, decrease in the amount of any liability, that will be on the credit side. Opposite thing, increase in the amount of any liability, as we have done for increase in the value of liability revaluation account to liability, as liabilities are always credit. So in that case, if increase, then debit side, and decrease, credit side. By asset, any asset not recorded in the books, because it will increase the debit balance of asset. Unrecorded asset, it will increase the debit balance of asset. So in that case, asset account debit by asset here in the revaluation account. And if there is unrecorded liability, then to liability, as liability is credit, so entry will be revaluation account to liability, and here it will be on the debit side, the liability not recorded in the books. Now if there is a profit, then to partners capital account, the profit will come here in the old profit sharing ratio. And if there is a loss, then by partners capital account, the loss transferred to the partners in the old ratio. So this was all about the revaluation account that is made on the admission of partner. Now let us do one example here to note down the various effects of increase or decrease on the of the assets on the revaluation account. Now here is first example. Assets and liabilities of the firm were revalued at the admission of a new partner. The following revaluations were made. Number one, the provision for doubtful debts at the rate of 10% was made on sundry debtors. Sundry debtors were 50,000. Then creditors were written back by 5,000. And then building was appreciated by 20%. The book value was 2 lakh. Unrecorded investments were 15,000. A reserve of rupees 2,000 was made for an outstanding bills of repair. Unrecorded liability towards the suppliers was 3,000. Value of stock and machinery to be reduced by 10%. Book value of stock 1 lakh. Book value of machinery 2 lakh. So all these were the entries. Now how they will affect? Let us check. The first one was provision. Provision for doubtful debts at the rate of 10% was made on sundry debtors. The debtors were 50,000. Now provision of doubtful debt. Provision is always a liability. So here let us check. Yes. Sundry debtors. Book value was 50,000 and a provision of 10%, that means 5,000. Provision is always a liability, so that will be on the negative side, that will be on the credit side, liability. Now let us check how the entry will enter. As the provision is a liability, so it will be on the credit. So to provision for doubtful debts, here what will we do? Firstly, we will put the entries on the credit or debit side and then total to the revaluation account. So first entry is the provision of doubtful debts, the provision of doubtful debts. So it is on 50,000 only 10%, that means only this entry. Two provision entry will be made to provision of for doubtful debts for 5,000. Okay, then creditors were written back by 5,000, that means debtors are written off. It means debtors reduce. When creditors are written back, that means creditors increase. So in that case, the creditors are debited in that case. So the creditors will be 5,000 here. This entry will be there. And then third one is building was appreciated by 20%. Book value is 2 lakh, 20%. That means 40,000. Now building account will be debited with 40,000. And then unrecorded investments were 15,000. Now investments are your assets, so investment account will be debited with 15,000. This will be here. And then next one is a reserve of 2,000 was made for outstanding bills of repair. Now reserve is liability, so it will be a credit thing. A reserve for outstanding repair bills. Then unrecorded liability towards the suppliers was 3,000. Suppliers means creditors was 3,000. So to creditors the amount will be 3,000. And then next, value of stock and machinery to be reduced by 10%. Stock book value is 1 lakh. Stock reduced, otherwise stock is debited. Now here stock will be reduced. So to stock 10%. And then machinery book value is 2 lakh. Book value is 2 lakh here. So the machinery, it will be credited 20,000. Now add all these credited items. All these items just add, it comes out to be 40,000. So debit the revaluation account value 40,000, and here with all the adjustments given, the total comes out to be 60,000. So credit this 60,000. Now if we prepare the revaluation account here, by creditors 5,000, building by investment, and here all the provisions, the balancing figure comes out to be 20,000, which is a gain of the partners, and it will be transferred to partners capital account in their old profit sharing ratio. That means revaluation account debit to partners capital account for the profit transfer. So it is the first basic example. In the coming video we will be doing two or three examples of the complete questions which come in the exam. Only practical questions we'll be doing in the coming video. I hope you have liked the video, you have understood the basic concepts of revaluation account. If you're getting everything very much clear, please do not forget to like and subscribe my channel. Thank you.